What caused historical price bubbles like Tulip Mania? Imagine a time when the price of a single tulip bulb could buy a house or a boat. That's what happened during Tulip Mania in the 17th century. It's a story of how prices can skyrocket beyond what makes sense. When demand for rare tulips grew, people started paying huge sums just to own these exotic flowers. Some tulips had unusual colors caused by a virus, making them even more desirable. Because they were scarce and seen as luxury items, prices kept climbing. People began buying tulip bulbs not for their beauty but to sell later at a profit. This kind of buying is called speculation. Traders used contracts to buy and sell bulbs for future delivery, even if they didn't own the bulbs yet. Easy credit and low interest rates made it simple to borrow money to buy more tulips. As more people joined in, prices detached from the actual value of the tulips. Everyone wanted to get in on the rising prices, fearing they would miss out. At the height of Tulip Mania, some bulbs sold for prices equal to several years of a skilled worker's income. It was a frenzy driven by herd behavior, where everyone followed the crowd. But the bubble burst suddenly when buyers refused to honor contracts or pay the inflated prices. Prices plummeted, leaving many investors with heavy losses. This event shows how market psychology and speculative behavior can create rapid, extreme price increases that have no real economic basis. Looking at this from a broader view, Tulip Mania helps us understand how asset prices can inflate quickly when demand is driven by greed and easy credit. While general inflation affects the overall prices of goods and services, bubbles are localized and happen in specific markets. They happen when investor behavior pushes prices for above what the assets are worth. Recognizing these patterns helps us see how markets can become unstable when speculation takes over. It's a reminder that prices can sometimes be driven more by emotion and hype than by real value.